And we go on to page 117, top of the page, we have conditional receipt. Okay, so here's a situation there, again, where you might see some test questions on your exam related to conditional receipt. So, we'll go over this again. I know we went over it in life insurance, but some of us here may only be doing health insurance. So, we'll kind of review this for those life students, and this will be new for those health students. But, similar example of what we went over before, when you're filling out the application, right at the bottom, there's a little receipt that you can tear off, which is referred to as a conditional receipt. Now, it's a receipt though, so you never give out a conditional receipt unless you receive the money. Now, what the conditional receipt does is creates coverage prior to the policy being issued. So, we'll say that I come in to see you, I'm filling out this application, I give you the initial premium, and I do this on 6/1. Okay, June 1st I do this. If you give me a conditional receipt that day, it will state in the conditional receipt what the conditions are to coverage. And it'll work one of two ways for the exam. It will either state that I am covered immediately with no conditions to satisfy, or two, that I am covered once I go pass a physical exam. So I fill out this application June 1st, you tear this off, you take the money, initial premium from me, give me a conditional receipt on June 1st, and it states that I'm conditionally covered if I pass a physical exam. So I go to pass a physical exam, do this on June 20th, pass that physical exam. When does my coverage become effective? Bang, right there, June 20th, once the conditions are satisfied. Now, say you gave me a conditional receipt that stated there were no conditions. And obviously I have to go do a physical exam. It's an individual policy. So I go do that on June 20 and pass it. When's my coverage effective? Back here, June 1st. Okay, that's a conditional receipt. You never give it out unless you collect the initial premium. It's a receipt. Now, conversely, there's also what's known as a binding receipt, which you see there in that paragraph. Binding receipt is unconditional. So a binding receipt, sometimes referred to as a temporary term of coverage, and not often utilized because it gives a person immediate coverage without any conditions. Conditional receipt is going to be much more common, and the use of the passing of a physical exam you'll see in the conditional receipt quite a bit. So first paragraph on page 117 says, when accepting the initial premium from an applicant, a producer usually gives a conditional receipt, which makes coverage effective on the date of application if the company finds the applicant have to been insurable on that date. However, some conditional receipts make coverage effective on the date of application or on the date of the medical exam, whichever is later. Remember, conditional receipt is never given unless you receive the premium. Okay, so we go ahead there, and in the next paragraph in that first sentence, there's where they use that term frontline underwriter as of the producer. 1, 2, 3. This paragraph is very important for the exam and for real life. Goes over what your responsibilities are when the policy gets issued. It says once the policy is approved and issued, the producer usually will personally deliver the policy to the insured. This enables the producer to thoroughly explain all coverage provisions, exclusions, and riders to the insured. Sometimes the company will mail the policy directly to the insured. Whether policy is personally delivered or sent by the U.S. Postal Service, most policies contain a free look. A free look is a period of time you have to return your policy. So it's your refund provision. Usually it's 10 days. So it starts either the date of delivery if the policy is hand delivered or the date of mailing if it's mailed. But keep in mind it's usually sent priority mail. So there's signature, certified mail, so there's a signature that's required there. Okay, a few paragraphs down, in fact the second large paragraph from the bottom on 117, it mentions a COD, collect on delivery submittal application. Okay, here's the difference. We talked about conditional receipt. You only give out a conditional receipt if you've got the money. It's a receipt. Well, how about this? You don't get the money. Person fills out an application and does not give you the initial premium. Are you going to give them a conditional receipt? No. Well, what are you going to do? You have to submit the application without a premium. So you have to do this, what's called a collect on delivery submittal application, COD. If the policy is issued, you will come back out and collect the premium. Remember, the premium is required to fulfill consideration. So coverage will never go into effect until you've received that premium. So really, two things of major importance in order for coverage to go into effect. The premium has to have been paid, and the policy has to have been issued. Okay, if both those have not occurred, we don't have coverage. So on a COD submittal, You have me fill out the application, everything looks good. I don't pay the premium though, so you don't give me a conditional receipt. You take the application from me June 1st. It goes to the underwriter, and we'll say that it gets issued on July 20th. Okay, so 7/20. So you come out to deliver the policy from me. Now, number one thing you have to do on the COD submittal is you've got to get the premium. Okay, because that fulfills consideration. Without the premium, there's no coverage. However, there's another thing you have to do. You have to have me fill out what's called a statement of continued good health. And this basically states that my health has not changed from when I filled out the application until when the policy is issued. Okay, those are the two things you have to do on a COD submittal, as they mentioned there in that paragraph. Bottom of page 117, individual underwriting by the insurer. So it kind of goes over these things we talked about in underwriting, that first paragraph. Company underwriter relies heavily on the completed app, producer's report, which I mentioned there, consumer investigative report, there's going to be the credit check, medical questionnaires, physical exams, information supplied by the MIB. Okay, so we go on to the next page, on page 118. Here's the MIB guidelines, what the insurance company has to do. It says MIB procedures require, number one, a written notice to the applicant. Insurance company may report health findings to the MIB. 2, authorization by the applicant for the MIB to disclose information of member companies. 3, disclosure to the applicant of information contained in MIB files upon written request of the applicant. MIB will disclose medical information only to the applicant's physician, whom the applicant must then contact. As we said, it's encoded. Okay, the information there is encoded. Then it gets into the HIV testing. Now, HIV testing, there are, by law, certain procedures the insurance companies have to go through. They have to have the applicant sign off on an HIV consent form. So you might see questions on this on your exam. The consent form, the applicant has to sign off on this, stating that they are aware that the insurance company is going to have a doctor do an HIV test. Also states in that consent form that the insurance company will share results of that test with only certain individuals. So it mentions there in that paragraph, put a star by that. No one may require the performance of an HIV-related test without first receiving the specific written informed consent of the applicant. So very important there. Now we go down to the bottom of the page, we have classifications of risks. And it says, in order to prevent adverse selection in the last paragraph, in group policies, the insurance companies created what they call participation percentages. So it states there, if a group is contributory, which means the premium is shared by the employer and the employees, the participation percentage is 75% of all eligible employees must enroll. If it's a non-contributory group, then it's 100% of eligible employees that must enroll. On page 119, top of the page there, you see non-contributory. Third paragraph down talks about loss ratios. Now, loss ratio, when we talk about an insurance company, is the amount that they pay out in claims per year as a percentage of the amount of premiums they collect. So if an insurance company has a 75% loss ratio, that means for every dollar they collect in premiums, they're paying 75 cents out in claims. The higher the loss ratio goes, the higher the premiums will have to go for the company, and maybe the more exclusions and better their underwriting will have to become. We can skip ahead to the bottom of page 119. It talks about considerations in replacing health insurance. Remember I said, if you're going to be replacing where a person cancels their health insurance, buys a new one from you, the pre-existing condition exclusion is going to be very important because it might start over again in their new policy. Now, replacement by itself is not illegal. Replacement to the detriment of your client is illegal and is referred to as twisting. We go ahead on page 120. It goes in again to the probationary period and pre-existing condition exclusion here. Further, let's see what it says of important. Second paragraph. In the center of the paragraph where it's underlined. While it is usually 12 months on a new policy, most states limit the probationary period to a maximum of 6 months. On certain types of policies, including Medicare supplements, these are all things we'll get to later, credit disability, which we already talked about, and long-term care policies. Remember, it says probationary period only applies to sicknesses. Oh, there's no such thing as a pre-existing accident, right? I mean, that's dumb. We go on benefits, limitations, and exclusions. We can skip down to waiting periods. In fact, waiting period, right above waiting period, I want you to write this word, elimination, because there's actually 2 words for this. waiting or elimination period. Fix that there. Okay, waiting or elimination period is a period of time that you have to wait until you're eligible for benefits in two different types of policies. Waiting or elimination period applies to disability income and long-term care policies primarily. And for your exam, usually they relate it to disability income. However, it's just a definition that you need to know. Period of days that you have to wait until coverage goes into effect and you start receiving benefits. Okay? So we'll talk more in detail about that, much more in detail when we get to the disability income section. So we won't really go into it too much here. On page 121, second paragraph, producer's liability for errors and omissions. What's errors and omissions? That's your liability insurance. Remember, we said doctors have liability insurance. It's called malpractice. You need liability insurance. It's called errors and omissions. So it says liability for errors and omissions. Where's there an errors and omissions situation? Replacement, we talked about. If you sell a person a new policy and they have a new probationary period in there, you're going to want to be very careful. Now, it goes into probationary periods and specifically mentions in the fourth paragraph down on page 121 the federal law HIPAA. So it says, 1996 Federal Health Insurance Portability and Accountability Act, HIPAA, has addressed the issue of new probationary periods that could occur when an insured changes health insurance carriers. HIPAA states individuals that terminate employment who were previously insured for at least 18 months on a group health insurance plan must be offered an individual health insurance policy without any pre-existing condition exclusion. This feature is commonly referred to as portability. Further, HIPAA also states group health policies must give credit for previous periods of creditable coverage when an employee moves from one group to another. As long as the coverage was continuous with no break in coverage greater than 63 days. Put a circle by that. Sometimes that's a test question. So you can have a gap in coverage from your old policy to your new policy, but it can not be longer than 63 days. If it's longer than 63 days, then you have to start over with a brand new probationary period. If it's shorter than 63 days, you can use any creditable coverage you had from the old policy towards the new policy. So it will reduce your probationary period in your new policy by however many months of creditable coverage you had in your old policy. And upon leaving termination of that group plan, you can request, and the employer is required to give to you, a certificate of creditable coverage to submit to your new group health plan. It says also, next paragraph, HIPAA limits probationary period for new enrollees in group policy to a maximum of 12 months and defines a pre-existing condition. Here's the definition. Medical advice, diagnosis, care, treatment that occurred within 6 months of enrollment. Pregnancy is not considered to be a pre-existing condition. Okay, and we can go ahead here. Well, I guess that's the end of the section. All right, so that's the end of basics. Now, what we're going to do next section is talk about the provisions built into these health insurance policies. So, review this section we just did, print off the next section, read through it, and then go ahead to that next video, and I will see you there.